An investor just celebrated hitting their full-time job dividend income on Reddit, and they're making $12.23 an hour. That's right, below minimum wage, below what you'd earn flipping burgers, and thousands of comments praised them for it. Welcome back to Wealth Blueprint Desk. Today, we're breaking down the exact math blindness that's trapping millions of passive income investors in a celebration of mediocrity, and how to spot it before it happens to your portfolio. Let's look at the actual post. The investor claimed they'd built a dividend portfolio throwing off roughly $25,400 annually. That sounds impressive until you do the math. $25,400 divided by 2,080 working hours per year equals $12.23 per hour. Now here's where the blindness sets in. They treated those dollars as if they'd somehow unlocked financial freedom. The comments flooded in. You've made it. Living the dream, full-time passive income. But the research shows something completely different, and that's what we're going to expose today. First, let's establish the portfolio size required to generate $25,400 in annual dividends. Using real dividend yield data from the last 12 months, we can work backward. The Schwab U.S. Dividend Equity ETF has traded at approximately 3.5% yield over the trailing 12 months. That's one of the higher-yielding dividend funds available to most retail investors. If you're earning exactly that yield, the math is straightforward. $25,400 divided by 0.035 equals $725,714 in portfolio value. That's the minimum starting point. Now consider what that means. To build a $725,714 dividend portfolio, research shows the average household would need decades of consistent saving. Let's use actual compounding math. According to historical Federal Reserve data on household savings patterns, the median household saves approximately $500 monthly. If we apply that to a diversified portfolio earning 7% average annual return, which is historical long-term market data from S&P 500 performance, $500 monthly compounded over 30 years grows to approximately $766,000. That's matching the $725,714 needed for that $25,400 dividend income. But here's the critical problem. That's a 30-year timeline before you hit that income level. And during those 30 years, you could have been building actual income-producing skills, advancing your career, or investing in other wealth-building vehicles. But the math gets worse when you factor in what research actually shows about dividend investing reality. Let's examine expense ratios, because they matter more than most investors realize. Which carries an expense ratio of 0.06%. That means for every $100,000 invested, you're paying $60 annually in fees. That's legitimately low cost. However, many investors chasing higher yields gravitate toward funds like SCHD or other high-yield ETFs that carry expense ratios between 0.35% and 0.40%. On that same $725,714 portfolio, a 0.40% expense ratio costs $2,903 annually. The difference between SCHD and a high-yield alternative, $2,843 per year in additional fees on that single portfolio. Over 30 years, that gap compounds. We're talking about $100,000 plus in lost wealth just from choosing the wrong fund. Then there's the yield comparison itself. VIM, the Vanguard High Dividend Yield ETF, has yielded approximately 2.9% over the last 12 months. That's lower than 3.5%. If you built your $725,714 portfolio entirely in VYM at 2.9% yield, you generate only $21,046 annually. That's $4,354 less per year than the scenario. For someone celebrating $25,400 as their breakthrough, this shows how fragile that celebration actually is. A single percentage point shift in yield destroys the narrative. Now let's talk about inflation, because this is where the real blindness shows up. The IRS and Federal Reserve research indicates inflation has averaged roughly 2.7% annually over the past 20 years. Though recent years have seen elevated rates. If you're generating $25,400 today, that purchasing power erodes. In 10 years, assuming 2.7% average inflation, $25,400 will have the purchasing power of roughly $19,700 in today's dollars. You're not actually hitting a retirement income goal. You're on a treadmill where you need to grow your portfolio constantly just to stay even. But wait, there's more. You can't grow the portfolio if you're living on the dividends. This creates a fundamental trap. The IRS publication 590B breaks down qualified dividend taxation. For most investors in the 22% federal tax bracket, roughly household income over $89,075 Long-term qualified dividends face a 15% federal tax rate. That means your $25. 400 gross dividend income becomes $21, 590 after federal taxes alone. State taxes could eat another 5-10% depending on your location. Net result, that $12. 23/hour celebration becomes roughly $10/hour or less after taxes. The Reddit celebration completely ignored tax drag. Here's where sector concentration amplifies the risk. Research from recent 10K filings shows the S&P 500 has roughly 28% weighting in technology stocks. Traditional dividend ETFs have shifted toward higher financial and energy sector weightings to chase yield, which creates concentration risk that mainstream investors don't acknowledge. If the dividend stocks your portfolio relies on get hit by sector rotation, which happened in 2022-2023, your yield evaporates. That $3, 5% yield from isn't guaranteed. It fluctuates based on market conditions, payout policies, and valuation cycles. Let's compare this to an alternative path that research actually supports. Instead of that 30-year grind to build $725, $714 for $25, $400 annual income, consider the compounding power of reinvesting. If you took those same $500 monthly contributions and allowed them to compound at 7% for 30 years without touching a single dollar, you'd hit $766,000. But then you'd have flexibility. You could live on 4% of that annually, $30, $640, which exceeds the $25, $400 dividend scenario. Or you could work 5 more years and hit $1, $2 million, generating $48,000 annually at 4%. The research on sustainable withdrawal rates shows 4% is the historical safe withdrawal rate identified by Trinity study data. That's where the real passive income math works. The investor in that Reddit post didn't understand the difference between earning on your money versus living on your money. They earned impressive dollar amounts, but fundamentally miscalculated the hourly value and completely missed the timeline. They were celebrating a 30-year project like it was a finish line. So what's the blindness actually costing them? Let's quantify it. If they'd spent 5 more years building that portfolio to $1 million, they'd generate $35,000 annually in sustainable income at 5% yield. That's still only $16, 83/hour, but it's better. And here's the real value. That extra 5 years of compounding would have added $250,000 plus to their portfolio, not from additional savings, but from compound returns alone. That's the time cost of celebrating prematurely. The data indicates most investors fall into this exact trap. They confuse dollar amounts with hourly value. They ignore inflation. They underestimate tax drag. And they completely miss the opportunity cost of a 30-year timeline versus alternative strategies like career income growth or real estate investing. That's not dividend investing being bad. That's investor blindness about what the math actually means. If you're building a dividend portfolio, the research supports several actual takeaways. First, use low-cost funds like SCHD 0.06% expense ratio rather than alternatives at 40%. That compounds into 6-figure differences. Second, understand your actual timeline. If you need income now, don't pretend a 5-year project is a 1-year project. Third, factor in inflation and taxes before celebrating. That $25, $400 becomes roughly $17,000 in spending power after taxes and inflation adjustments. Fourth, compare to alternative strategies. Could you earn more by advancing your career for 5 years? Probably. Could you deploy capital into real estate or your own business? Maybe. The blindness comes from not comparing options. The Reddit celebration represents a common investor mistake, feeling wealthy from total dollar amounts while completely ignoring the hourly value and timeline required to get there. Research shows the investors who build actual wealth understand these distinctions and plan accordingly. They don't celebrate prematurely. They calculate accurately, and they build real passive income, not the illusion of it. Stay informed. See you in the next breakdown.